Certainly there's a growing supply-demand imbalance in residential development and property, and that's something that we see as a future opportunity.
But I think we're getting a much divided country in terms of values. The north has got forecast much higher growth than the south and London. London is still London.
They're looking for more boutique schemes, niche schemes that have a bit more identity to them, but more importantly, schemes with less amenities and service charges that are more affordable.
Grade B office is struggling. That is an opportunity right there if you can find them. Plenty of people willing to sell them.
Demand isn't a problem, alignment is. Today, we're discussing the current state of the UK residential and development market and where it may be heading. I'm joined by Edward Rothery, who is a chartered surveyor in the valuation team at Colliers, who brings a research-led perspective on market conditions and where the UK residential real estate may be heading. I'm also joined by Matthew Taylor, who is Managing Director of UK Residential Development at Consulco Group, who's leading the growth of Consulco's UK residential development platform, and who works closely with developers navigating today's market. Together, we will explore whether the market is stabilizing or starting to turn, and what that means in practice for developers, investors, and lenders. Ed and Matt, thank you both for being here. So Ed, I'd like to start with you. How would you describe the UK residential market today, and how different does it feel compared to 1 year ago?
So compared to a year, 2 years ago, I think there's a big market change since then. In that time, there was a lot of shock, the increase in costs, a lot of uncertainty related to the budget and the new government and sort of worldwide factors that kind of paralyzed a lot of people. But now, this year, we feel like there's been a little bit of a shift in mentality with people. It's not fully buzzing, the market's not flying and red hot at the minute, but it does feel like there's more confidence. There's been a bit of stability, and developers, buyers, sellers, look like they're ready to move and get cracking. So we're positive, and we're hoping it'll continue through 26.
So you would say less panic than a year before, but not full confidence quite yet.
Yeah, I think butchering a phrase that I'd rather not, but green shoots are there compared to a year ago.
Would you say cautiously optimistic?
I would definitely say cautious. There is optimism brewing. I'm not sure everybody is optimistic at this moment in time. There's still a bit of a split. There is a bit of a feeling growing that we're going that way.
So really, there's a lot of mixed news right now in the market. And from what you really are seeing, how do confidence levels compare with what's actually happening on the market?
I think this relates quite a bit to what you were saying about if there's cautious optimism. There is definitely optimism building, as I said, but it remains cautious. I think headline-wise in the news, you won't see a huge amount of deals happening. There seems to be, especially commercially, there's a lot of off-market deals that get done. Whereas obviously residential, there's not as much of that kind of the market. But we've spoken to a number of the large residential developers who said a year ago, 18 months ago, their sales rates were close to 1 or 2 a month, which is not very good for a housing estate.
That's pretty low.
It is pretty low. But now they're seeing closer to 4, 6 for some schemes. So they are the first steps in improvement. If that continues, the market stays stable, we should still hopefully see the wider residential market improving.
Yeah, I'd agree with what Ed is saying there. It is cautious optimism. I think you see, dare I say the phrase, green shoots, or a little bit more stable market, a little bit less uncertainty. But certainly we're not back to kind of pre-COVID or pre-global financial crisis in terms of sales rates and confidence in the market. But certainly there's a growing supply-demand imbalance in residential development and property, and that's something that we see as a future opportunity.
The factors that really caused the problems, which was mainly the construction costs and rates, are construction costs never go down, but they have stabilised, and therefore it gives some certainty to developers. They know what's happening. They can plan for certain things. For example, a standard housing estate, the actual build costs now are fairly standard across most. The margins are low, and that's the problem now. And hopefully with the rates dropping a little bit further, that just gives that bit of movement that allows you to play off. If your margin's gone down, but you can save a little bit on your finance, it makes more things viable. And we're hoping that as the years go on, that's what brings things forward.
How are property values and rents changing? And how important are these changes really for making development projects work again?
The value part of the equation obviously is very important. No one wants to lose money. And with the cost side having gone up, then you kind of need to balance it out. I think the data is sort of showing that the last year hasn't seen significant increases in values. They've been fairly broad. Rents have slowed down a little bit as well. They obviously, for the past few years, have shown quite big increases. They've slowed down. But I think we're getting a much divided country in terms of values. The North has got forecast much higher growth than the South and London. Previously, it was the other way around. The North didn't see the growth and the South did. Now we're looking at maybe, buyers and investors are trying to get a little bit more property for their money. So they're going to those cheaper areas. They're investing in the sort of northern cities in Scotland. So that's where the growth's likely to come from. And hopefully the developers will be able to provide that up there, which will eventually filter down as the values go up north. Eventually the South should speed up again.
I'd agree. It's a mixed bag across the UK. Affordability led in the main, especially with income multiples, mortgages. But I think we are starting to see a bit of a tipping point in respect to rental price growth, affordability of mortgages and purchasers wondering what's best for me next. But I agree with Ed. The North certainly represents value, both in the short and medium term. But I think we still remain confident that London has gravity. It's a pretty stable market, a deep market, typically. And we're confident that in the kind of short to medium term, we'll start to see better growth potential within the capital as well.
So we mentioned costs before. Let's talk about costs. And like you said, Ed, before, construction costs have been a huge challenge, really. Do you feel like they're starting to stabilize the costs? And what does it really mean for developer margins?
From what we can see, the construction costs are definitely not increasing at the rate they were before. I think if you look at the inflation figures for construction costs, they're broadly double from 2020 sort of level. But actually, we know certain elements of that, they're potentially as high as 3 times for certain elements of construction, which just wiped out a lot of margin anyway for developers. As finance rates increased, your margin was under pressure. If you then had the construction cost increase as well, it really did stop a lot of developments being viable. Good developments across the country, that schemes that 10 years ago would have just gone straight up. So I think now that we've seen the growth slow, it's more in line with sort of the wider inflation. Hopefully, we can get property prices to increase at a higher level, or at least match would be beneficial, I'd say. And then with the rates lowering, obviously that helps your mortgage costs. There is more mortgage products out there as well, which just increases the buyer pool, which hopefully will push up prices. And development finance, we know a few of the lenders are looking to actually lend more for development finance. So again, a bit more competition in that market helps push down the lenders' margins, which hopefully gets a better deal for some developers. And those borderline schemes where people were worried that construction costs could increase again, or the value might not take that step in the 12, 18 months they were developing it, they now might have that little bit more room for movement, provide a little bit more profit, just allow some developments to start. And I think once they start, the floodgates will open a bit more.
Actually, that's great. Let's talk about finance a little bit more. So how would you describe the availability to development finance right now? And do you feel that lenders are becoming a little bit more open, or are they still remaining slightly cautious?
There's a lot of development finance potentially out there. There's a lot of lenders willing to lend on it. There's a lot of money sat there ready to go, forward funding schemes from sort of pension funds and things like that. The problem is is meeting the criteria quite often.
So they become a little bit more conditional.
A little bit more conditional. Yeah? The lender might have a outlook that they want to get into development finance, but when they are presented with developments, they might not meet stricter criteria they have than previously. The scheme might not show the return that the bank thinks that they would like to lend on in case something goes wrong. But we have seen some mid-tier lenders willing to refinance developments that are already in process. Historically, very few did unless it was a bridging loan. Now we have seen senior debt move from one lender to a different lender because they can get a better rate. That is a good sign that a lender is willing to take the risk that our scheme, there was no issues with the scheme. It was proceeding nicely. But the developer, obviously, as you would expect, wants to get a better return. They found a lender willing to give them a better rate. They moved it and the lender was happy with it. So I think we'll get a few more deals like that happening and it should see more developments viable. And obviously there's always the smaller lenders who, they are always much more collaborative with their developers, I would say. And I think that's a good thing. I think developers should take the opportunity to look at those small lenders. If they've got a track record, they're not lending at any crazy rates or anything like that. It is definitely something that will release a few more developments.
Smaller lenders can be a bit more flexible as well.
They can be flexible. You often have much more contact with them. They can take a commercial view on some elements. Maybe there's a delay in construction cost, or for example, there are factors that can be put in and maybe the loan doesn't get as onerous to the developer as it would maybe for a large lender who has the banking criteria they have to meet. And if they don't, they're in trouble. So obviously that always gets passed down. So I always think there's a relationship with the development and the lender. And if you can create that, I think it will really help things.
Yeah. Speaking of developers and relationships, Matt, what are your thoughts on this?
Current market conditions, and there's a lot of willingness from the developers to seize a moment, take an opportunity and see some smaller schemes come through to delivery. But most SME developers without the track record and perhaps only the management experience and perhaps the deals themselves do struggle to obtain finance on occasion because of the tighter lending restrictions that Ed's spoken to. I think that's where we at London Credit and Consulco try to differentiate ourselves by being a more relationship-led, partnership-led lender, where we can afford the opportunity to get to know the developer in a bit more detail, look at the bigger picture of the development projects themselves, build a relationship with the management team, understand their capability, their credibility, and not just look at the spreadsheet and the financial figures of a development. There's a lot of nuance there that sometimes gets lost if you're appraising schemes from a laptop and just looking at spreadsheet. We like to delve into the detail and really work with developers to find a funding solution with them and for them.
So it's, like you said, with an Excel sheet, it's not quite an Excel sheet exercise anymore. It's actually knowing the project, the full scope of the project.
Absolutely. It's buying into the story of the project, its origination, the business plan, the reason to invest, and really working with SME developers that we know they've got more constraints than the bigger house builders, and we need to take a tailored approach with them, work in partnership and find solutions, not just being a typical kind of retail funder.
And one more question for you on the market that we discussed. So when you look at the market, are you seeing any signs that things might be starting to improve, or do you feel like it's still too early yet?
I think there are signs that the market is returning to strength. Obviously, you mentioned earlier about the sales rate for some of the large developers. That's always a good sign. They need a certain amount of sales to make those large estates viable. So that improving is a very strong sign for them. And the fact that they are also buying up other sites ready to develop. There's a slightly longer term play with some of the schemes. There's not many ready to go sites with planning consent being purchased and built. They're often a little bit more longer term play, ex-farmland, that kind of site. But they are at least putting capital ready to develop, which can only be a good sign because you wouldn't invest that kind of money now if you didn't think it was going to you couldn't do anything for 5-10 years. So that's always a sign.
That's positive news.
Yeah.
Or early signs, not full recovery yet, but getting there.
Getting there. I think
Yeah.
other factors such as the mortgage availability and the number of products that are available to sort of first-time buyers. I think one that we're quite excited about is the one that is now offered for renters from Skipton Building Society, who use a track record of paying rent as proof that they can actually pay a mortgage, which obviously a lot of people have cried out for many years, that why can't I have a mortgage if I can pay rent? And
That's always been the big question, hasn't it?
And now,
And what's the answer right now?
well, hopefully this product will work and we'll not have a catastrophe from it, which means then hopefully other lenders will look at it and see it as a viable option. They're offering 95% and 100% loan to value on it. So that allows people to get going without the huge deposit requirements, which I know is another problem for especially first-time buyers. So all these little factors hopefully will start to snowball. It's not perfect with everything. I think a lot of as we said earlier, the north was the growth potential. I think the lower and mid-tier ranges of properties seem to be the ones that have the most growth potential. Places like central London have had a lot of co-living and build-to-rent sort of built that have quite high rental points. And that market is a little bit saturated. There's not a huge amount of demand, or it's the affordability matter, I think, potentially is what's affecting it.
I was going to step in there and say, affordability being the biggest drawback of London. I think in terms of supply-demand imbalance, it's probably the most acutely seen in London in terms of delivery, supply and growing demand. But to date, mortgage products have been out of reach. Deposits have been out of reach for first-time buyers, but hopefully we start to see some movement there and affordability comes back into range. We're certainly starting to see, off the back of recent rate cuts, fixed-term mortgages under 4%, subject to the level of deposit. Certainly under 5% if you're at 5%, 10% deposit, which is good news. Against the backdrop of further rate reductions of maybe 25 or 50 basis points over the next 3 to 6 months, hopefully that will bring mortgage rates down further and further help affordability for first-time buyers, in particular in the London market.
I think that sounds very promising. And actually, I would like to talk to you a little bit more about developers, because I know you talk to many developers. How do you feel that they are adjusting their plans in this current market?
We engage with a number of developers, in particular SME developers that we were speaking about earlier. And that's proactively, not just with developers actually, contractors, QSs, consultants, agents, and sitting down also with local authorities, with big housing targets, just to understand current market dynamics, what's actually happening on the ground. I'd point to even 3 or 4 conversations that I've had in January 26. A developer that I spoke to focused on the North London market, also a developer and contractor, and they've made a conscious decision to move away from larger scale development projects, mainly because of planning delays and the risk is attached to the gateway approval process with the new building safety regulator. So he was saying, looking at his order book this year, a much bigger percentage is made up of conversion, refurbishment and slightly smaller schemes. And he, as a developer, is looking to focus on that section of the market where it's a bit more forecastable, a bit more predictable, and he's tying up less capital in one particular project at any one time. So I think that mirrors a lot of Consulco's thinking and London Credit, what we're hearing from the SME developers that we're providing funding to. Another developer I spoke to as recently as last week is focused on partnership working. They are an ex-director of a tier 1 main contractor, as well as working for one of the G15 housing associations. They feel that they can source the opportunities, offers that were made perhaps 12 months, 18 months ago that were rejected. Those landowners are coming back to them now with slightly more realistic expectations. So the confidence is there that the deal is to be done. But despite the management capability and experience, despite having an in-house partner as a contractor, he is very much struggling to obtain development finance. So different forms of debt, equity and partnership working, and to see how we can bring some of these development opportunities forward in partnership. Another developer His clear message to me was the market off the back of Ukraine, energy price spikes and inflation. It's all about robust cost control. It's about high quality design, but well coordinated design, just to make sure that you stack things in your favour to ensure that schemes are viable and can be seen through to delivery. I've also been speaking to various QSs and other contractors, all saying a common theme. A lot of the order book is refurbishment, conversion, permitted development and smaller scale schemes, as opposed to larger developments or regeneration schemes that have been affected by significant increases in construction costs and large concerns about sales rates that Ed pointed to a little earlier. In addition to developers and contractors, I've also taken some steps to speak to purchasers, just to understand what is a purchaser in London or elsewhere in the UK looking for in the current market. A common theme, as I mentioned earlier, is that rental prices have seen some serious growth. Mortgage rates, though, are coming down, and they feel as though they're at a bit of a tipping point to consider their options, whether I rent or do I consider buying with another professional partner, maybe. When they're looking for new properties, though, they're switching off their interest for larger scale volume house builder developments. They're looking for more boutique schemes, niche schemes that have a bit more identity to them, but more importantly, schemes with less amenities and service charges that are more affordable. Rather than pay through the nose for service charges and amenities, gyms, swimming pools, other facilities that after a couple of years they realise they're no longer really utilising.
So that's not so much in demand right now. It's more focused on the smaller, simpler projects.
Yeah, no frills accommodation where it's easier and cheaper to just join the local gym or use the local swimming pool than pay for a service or an amenity that you're not necessarily maximising the use of.
I think even everyone is becoming a little bit more cautious how they're spending money. So
with what Matt's saying about not having everything under one roof sort of thing, that I think is where a lot of the co-living schemes have hit a bit of a wall. They were priced at a suited to make it viable in the last few years. They were priced at a super premium point with office space in them, coffee shops, bars, rooftop cafes, gyms and swimming pools. You had to charge a certain amount to be able to afford that, to build it and to then obviously run it. And then when we were saying that those really high rents, people aren't taking them on. And that's one of the reasons, because they can get those options everywhere. In the UK, we do have a lot of very good value gym chains now. They've spent quite a few years investing in their stock, but they've had refurbishment programs. So now they're quite nice places to be. So people are happy to spend £20, £30 a month there.
Right.
And they can probably then get a flat for £100, £200 a month cheaper. The calculation definitely is for the renter.
Well, that's
in
really
that scenario.
interesting, yeah.
And that's why those larger schemes went up, because they were based on a value with, at the time, achievable rents. If you can get them, they're now not getting the occupancy at those rents to be as viable.
Yeah, a lot of those kind of premium build-to-rent schemes are also quite inward-looking. And I think there's an awful lot more encouragement from local authorities to look at schemes that are outward-looking. And part of a mixed-use regeneration scheme that goes beyond the residential apartment block itself, and amenities provided alongside as opposed to part of a service charge. But I think you're right, Isabella, cost of living has driven a lot of the decision-making off the back of energy bills, your grocery shopping, you name it, everything's pretty expensive nowadays. So it was welcome news to read today about ground rents and a bit of a cap coming in now from central government. I think £250. That will be welcome news to purchasers and hopefully eases some of those cost of living pressures.
Matt, I want to talk a little bit more again from a lender's perspective. So we said that before, but can you elaborate a little bit more on the fact that lenders are no longer just looking at the numbers, but they actually want to see the full scope of the story? Give us a little bit more information on that.
It kind of builds on what Ed was touching upon a little earlier, that post-global financial crisis, lending restrictions are a lot tighter. It's lending by numbers only and spreadsheets. And this is the niche of London Credit and Consulco, to really look at the finer detail, to get to know a business in greater detail, build a view of the bigger picture of the business, the management team and the projects themselves, and perhaps back SME developers that aren't quite so risk averse and see this more as an opportunity, begin delivering when volume house builders perhaps have turned their back on London because of concerns about affordability. But you see growing supply-demand imbalance and a need for SME developers to fill that space. And certainly from Consulco, London Credit, and our approach is relationship-led. It's about partnership working and hopefully repeat business with the same developers, that we really buy into them, we buy into the business, and we buy into the projects that they're backing. And we see them almost as an extension of ourselves.
So you mentioned SME developers. Let's talk a little bit more about them. And I have a question for each of you because you have two different perspectives. So starting with Ed, are you seeing more activity and interest from SME developers right now? And then if you could follow up and give your information on where do you see the main opportunities and risks for the SME developers right now?
There is a good level of interest in the market for it. As we've been saying, there's been years worth of issues from either costs or finance. And I think in the past, you often had the juggling of a development. There was a bit of flexibility built in, let's say, for obviously values, construction costs, debt, and sort of profit. The four things. There was always a little bit of a leeway that you could move it round. If your values didn't go up as much, you could accept maybe a little less profit, or if the values went up, you got more. And all these little bits moved around. And in the last couple of years, those have been much tighter. And one little movement or not enough movement in one of them would make the scheme generally unviable. I think now, with that sort of balance more in the market and a bit more stability, those SMEs who have that flexibility built in, Matt obviously mentioned earlier some developers who have got contracting arms. Those kind of developers who have maybe some sort of savings that others don't, they can go in because they can take a view. And I think that's what we're seeing at the minute. It's sort of the early adopters. They're going in. We're not getting huge redevelopments as before, but there's some quite nice refurbishment schemes going on. I think the wider market, commercial and residential, it's still generally a sort of a flight to quality. People want nice product. So I think that's where the developers who are going ahead with it, they've got an advantage, and hopefully they'll carry on as well.
The developers notice the trends and they went for one.
They know that they can continue to make money. You know, development's been difficult. It's not been completely unviable, but you had to get things right. And those are the developers that continue to do so.
And risks and opportunities?
There's still opportunity as the market begins to stabilise. Whether it's fully bottomed out, fully stabilised is another question. But yeah, there's risk, but there's certainly opportunity. I think the biggest opportunity is looking at kind of central government support for housing delivery, going to be a key driver of UK economic growth. The Labour government has doubled down on its target for 1.5 billion homes this Parliament.
That's a lot.
It's falling behind, and I suspect there'll have to be further regulatory planning reform and perhaps government stimulus to further boost housing delivery, and various initiatives in terms of planning policy and in terms of regulation and exemptions to make things a bit easier for SME developers to enter the market and to scale up as things stabilise and the market conditions improve. SME developers are far better placed to tackle infill development, refurbishment, conversion, both small schemes, less than 10 apartments, say, or up to medium schemes, a new category, up to 49, 50 apartments across the UK. The bigger house builders just can't compete in that space because of overheads, because of the nature of their business. But if you're agile enough, if you're brave enough, sometimes as an SME, I think there's a great opportunity to step into that space and really take advantage of an improving market and more stabilisation. You've also got, alongside stabilisation of costs, further interest rate cuts that are predicted, as I was saying earlier, perhaps 25 or 50 basis points over the next 3 to 6 months. Alongside the planning policy and regulatory reform and exemptions, construction costs and inflation are stabilising. There's the prospect of further interest rate reductions. And I think this all throws into the mix to provide a bit of cautious optimism that perhaps now is the time to invest and have more confidence. The market is more predictable, slightly less uncertain, and they're the foundations for investment usually. I think we just need to be selective in terms of where we invest and the types of schemes, looking at, I suppose, established locations with high demand, both in the capital in London and other hotspot regions across the UK.
So looking ahead at the next year or two, what do you both think that investors and developers should be focusing on right now?
I think it's a matter of they need to know their business. They need to know what their aims are. Because as we've said, products that are aimed at certain markets are doing well compared to sort of general. So it's knowing what you're going for. Don't just build a general or refurbish a house to provide some flats. Is that demand in that market? If there is, then great. If there's not, it doesn't matter if the wider market is saying these are the things that are working. It needs to be very focused, I think, for the next year or two, while there's still a lot of risk overhanging. Until we get the roll going, I think people still need to take early planning stages, very important. Build the relationships with your lenders and your agents. They'll tell you what is selling or what they think they can sell. It's quite important, I think, that view is taken on board. There are certain markets, low and mid-tier markets are probably got the greatest growth. If you can make those stack up, that is probably where it needs to be. London, we're probably looking at refurbishments and slight extensions because high density schemes just aren't really viable at the minute. But if you can refurbish and you can price it at a level where there is money, London is still London. Old office buildings, without trying to veer too much into commercial, Grade B office is struggling. There's probably a big opportunity there to get buildings that before would have been definitely refurbed back to office. Steel framed, quite modern buildings, but if they've not had the money spent on them, the refurbishments costs to Grade A office where the demand is, isn't that much lower than probably a full scale refurbishment to residential. That is an opportunity right there if you can find them, and there are plenty of people willing to sell them.
Yeah, it sounds pretty simple, but it's not easy. Matt, what do you think?
Next year or two, I think the market will continue and hopefully will have stabilised over the next couple of years. But with modest rental growth, price growth, cost stabilisation, as we spoke about earlier, interest rate reductions, improving affordability, I think this all goes into the mix of making or improving the viability of many development projects. It's been a challenging few years, but I think there's a little bit of light at the end of the tunnel, so to speak, and like I say, some cautious optimism as we go forward. I think we do need to be disciplined and very selective in terms of the type of development scheme that we look at and the approach that we take. Being very selective in terms of location, price point, established markets, not very early phase of a big regeneration scheme, assuming huge price uplift to cover off some of the construction costs. You've got to work hard to make schemes viable in this market, and robust cost control, governance, good design are a key part of that. Partnering with the right developers, as Ed said, perhaps with in-house construction expertise, that they're building at cost. It's not necessarily another overhead and profit centre. Will help make many schemes viable where others would struggle to make them stack up. I think focusing on smaller schemes, spreading risk, diversifying the portfolio, not just in terms of geography, but the nature of the schemes that you look at and in the portfolio. A big advantage is sales rate exposure and not being left with an asset and stock. Working in partnership and being flexible in terms of your finance or partner. That's where London Credit and Consulco come in. We're looking at a blend of funding options from equity, senior debt, mezzanine, but working in partnership rather than a developer doing things and taking all the risk themselves, spreading that risk and sharing as we scale. I think we need to keep an eye on ESG, sustainability as we go forwards. Buyer behaviour, your purchaser and what they're looking for and demands we shouldn't forget. And we need to future-proof our schemes with a lot of further regulatory reform coming. We need to future-proof and make sure that we're ready.
It's a lot of useful information that you have shared today. And I'd like to ask you one final question. Since we have discussed the market, if you had to describe the market that it is today with just one short sentence, what would you say?
I'd have to say cautious optimism.
Cautious optimism.
There's an underlying strength to it, but there's risks there, yet there are signs of recovery.
I think it has been a tough period and few years for the sector and industry. There are no silver bullets. It is a lot of hard work that needs to be done as we go forward. But I think if you are agile, if you are focused upon the smaller end of the market and diversifying your exposure and portfolio, I think there is an opportunity there.
It's basically a market that is finding its footing again, isn't it? And then really, especially for those who are staying, as you mentioned, agile, disciplined and adaptable. Thank you so much for joining us today.
You're welcome. Thank you.